In 2010, India was a very different country. Internet penetration was 7.5% versus 75% today. Digital payments were almost non-existent and smartphones were still at their infancy in India. We had a 33% penetration of smartphones in 2010 versus a 78% penetration. And it is in this different India on the 15th of August 2010 that Nikhil and Nitin Kamath began the operations for Zerodha. On 28th September 2012, Nitin Kamath wrote in the Z Connect blog, the plan is by April 2015 to be the best brokerage in India to provide a technology edge to the Zerodha clients. And 12 years later, Nitin came back and wrote, we started Zerodha in 2010 and in the first decade or so, we often found ourselves asking, when would the Indian capital markets expand? And given the monumental changes that have happened in India's capital markets, there is no single publication that has documented the profound transformation that has happened in the Indian capital markets. On 27 March 2025, in partnership with the IndianDataHub, Zerodha released its first edition of the Capital Markets Yearbook. So welcome to this week's breakdown, where we analyze Zerodha's 2024 Capital Markets Yearbook. The Breakdown YouTube channel is part of Zerodha's 01 Media network, and we're extremely grateful for the help, support, insight that is provided by Zerodha. Thank you, Zerodha. Back to Breakdown. The first mind-blowing insight from Zerodha's Capital Markets report is that the duopoly is becoming stronger. And they have focused on three duopolies that are emerging in India. The first is in cement, the second is in telecom, the third is in airlines. Now the cement one is not as obvious to us because as consumers, not a lot of us go about purchasing cement. Cement is purchased by the contractor who is either building your house, renovating your flat, or doing some repair or maintenance work at your residence. But when it comes to telecom and airlines, we definitely are customers. The chart in front of your screen shows you how the duopolies in telecom and airlines in India continue to become stronger over time. The percentage figures that you see there is the market share held by the top two companies in that sector. The top two for telecom are very obvious. It is Airtel and Jio. The top two for airlines is Indigo and Air India. So a quick recap of what has happened in telecom in the last 5 years. Vodafone, which is today called V, has defaulted on payments for the spectrum that it has purchased in auction. And as a result of this, in February 2023, the government first took a 33% stake. And as of the time of us recording this video in April 2025, the government has hiked that stake from 33% to 48.99%. And Jio and Airtel are way ahead of where Vodafone is now. In fact, in March 2025, both Jio and Airtel came out with press releases saying that they are working on partnerships with Starlink to bring Starlink's technology to India to provide wireless satellite connectivity in rural and remote parts of the country. When we look at the data from the last 5 years for telcos, there is a shocking takeaway. And this is that, on average, the amount that is paid to the telcos has increased by anywhere from 50 to 100%. It is 58% if you are a Vodafone user, it is 81% if you're a Reliance Jio user, and it is a whopping 120% if you are an Airtel user. So as an Airtel subscriber, the average revenue has grown from 126 rupees to over 247 rupees. The shocking insight here is how much the average revenue per user has moved, which means you as a subscriber are actually paying a lot more for your telecom services today versus 5 years ago. The exact numbers: Vodafone was an average revenue of 108 rupees. Today it is 163 rupees, which is a 50% increase. Bharti Airtel was 126 and it is today 247 rupees. That's a 96% increase. And therefore, if you have been an Airtel subscriber for the last 5 years, on average, the amount that you've paid to Bharti Airtel has doubled. And this is, by the way, quite a feature of a duopoly, which is that there are steady and gradual price increases over time because customers naturally hesitate to switch. Despite Vodafone's service being what it is, I and a lot of my friends have not switched off Vodafone, and these gradual price hikes are compounding over a 5-year window. Now, the airline space in India is dominated by two players. Indigo, which has a 63.7% market share, and Air India, which has a 27% market share. You'd be amazed to know that Indigo Airlines has a market cap of 2 lakh crore rupees today, which translates to approximately 23 to 24 billion US dollars. This would make Indigo the second most valuable global airline, which is just little behind Delta Airlines from the USA. In the last 5 years, you'd be amazed to know that the price of airline tickets has moved, according to industry research, by about 43% in the last 5 years. But when you go onto social media, you will every week find someone outraged that airline ticket prices are high. Let's forget the fact that amongst lakhs of tickets being issued in the day, they're generalizing price hikes based on their personal experience, which is not correct. The reason why we feel the pinch of the airline ticket cost hike versus that of the telco hike is that your telco cost is 200 to 300 rupees a month, but a single airline ticket is 3000 to 4000 rupees. And this is a classic example of how, as a user, we feel the pinch in our pocket only when the amount of money is beyond a certain threshold. So while people complain about airline prices rising, no one really complains about how telco prices are rising. Takeaway number 2 is that FIIs, foreign institutional investors, are fair weather friends. Both FDI and FII involve the investment of money by a foreign entity. The difference between FDI and FII is that foreign direct investment is investment in an operating company to run a business. So let's say a foreign multinational corporation invests 1,000 crores to set up their Indian subsidiary to provide their services or goods in India. That is an example of FDI. But if the same foreign multinational corporation from its investment arm decides to buy stocks of Indian publicly listed companies, that would be an example of FII. And when we look at the net cash inflow over the last few years, this is what we have learned. In 2021, the FIIs invested net $3 billion into India. In 2022, they took out net $16 billion, only to come back in 2023 by investing $21 billion. And in 2024, they invested an additional $2 billion. So net FIIs have invested $6 billion over the last 4 years. And you know the truth? The Indian domestic institutional investor has invested net $10 billion per year at the minimum for the last 4 years. What is the net cash inflows by the domestic institutional investor for the last couple of years? In 2021, the net cash inflow was $11 billion. In 2022, $18 billion. In 2023, $22 billion. In 2024, $48 billion. So the media is absolutely in love with these people who have invested net $6 billion over the last 4 years. But I've completely forgotten the fact that the domestic institutional investor has put in more than 10 times that amount in the last 4 years. And trust me, the domestic institutional investor focuses on the Indian market. The third insight, who cares about FIIs? I personally don't, and the best part is the data in today's report tells you exactly that. When we look at the ownership of the index across FIIs, promoters, DIIs and others, and this chart is a perfect example of narrative violation. What is the narrative on the street? Promoters are dumping on retail. What does the data tell us? Promoter ownership has only moved from 51.3% to 51.5%. What is the narrative on the street? That FIIs control the market. What is the reality? FII ownership has dropped from 19.8% to 17.7%. And who is the anchor in all of this? The domestic institutional investor. The domestic institutional investor has grown from 11.6% ownership to 14.9% ownership. And therefore I ask people, why do you care so much about the FII? The data clearly tells us that the public narrative is not supported by the data. The fourth takeaway, India is still expensive, but who cares? The answer to how expensive India is relative to all global markets comes from Morgan Stanley Capital International, MSCI, that publishes the MSCI index. You can think of the MSCI index as a product from Morgan Stanley that allows institutional, retail, and all forms of investors to invest across currencies, across commodities, and across countries to get a very nice diversified global exposure. Now, there is something called the MSCI Emerging Market EM Index. The EM Index from MSCI is a tracker on 24 emerging market nations, including India, the Saudi, China, Brazil, and 20 other nations. And you'd be amazed to know that the average country which is in the MSCI Emerging Markets Index, has a index level price to earnings ratio of 14. India's price to earnings ratio hovers somewhere between 20 to 24 times, depending on when you have looked at the numbers. This report looked at it in December 2024. I am looking at it again in April 2025. So depending on where India's price to earnings multiple is, India trades anywhere at a 50 to 70% premium over all other emerging markets. And that's simply to say, India is expensive. But who cares? People still buy it. The fifth takeaway is everyone is an investor. It took a period of 8 years to grow from 1.5 crore to 3 crore Demat accounts. And it took only 3 years for the next double. The rate of onboarding of new investors to India's capital markets has not only been blisteringly fast, it has also accelerated until the very recent downturn that has happened from January 2025 onwards. And when we look at the data, there are 11.5 crore unique PAN card holders who have a Demat account. There are 5 obvious reasons for this acceleration. The first is Geo, because now we can all access the trading terminal from our mobile phones. Social media, because the rise of YouTube and cheap data has allowed all of us to hear about who is making money in the market, what are the stocks being discussed. The third reason is that public markets have genuinely become part of our work discussions at the water cooler in the office. The fourth reason is the rise of zero brokerage. The zero brokerage insight is exactly the same as the Amazon Prime no delivery cost insight. The fifth and final reason is we've all gone from accessing a physical broker and signing physical pen and paper forms, which is what I have done even in 2016, 2017, to being able to access our favorite stock broking app from the comfort of our mobile phone, courtesy Zerodha and its other discount stock broking peers who provide mobile trading terminal. The sixth takeaway is India's capital markets are truly deepening and the large cap is not so large anymore. The data tells us percentage of market cap that is held by the top 50 companies in the last 15 years has declined from 74% to 36%. The percentage of market share held by the top 100 companies in India has declined from 87% to 51.3% in the last 15 years. So there are two questions in my mind. Is market cap in India still concentrated amongst the top 50, top 100 companies? And number two, is India really the IPO factory of the world? The answer to the first one is a very easy no. When you go to the USA, Magnificent seven companies alone account for more than 30% of the market cap. And this is very obvious because these Magnificent 7 are often global technology companies. A lot of India's top 50, top 100 companies may service select overseas markets but do not service the whole world. So India is not heavily concentrated in the top 50 or top 100 companies. And you'll also be amazed to know that the composition of this large cap in India is also changing. Initially, it was industrial and consumer. It is transitioning away from industrial and consumer towards financial services and technology-enabled services. Now, when it comes to India as the IPO factory, the media likes to portray the SME IPO as the reason why India is the IPO factory. The harsh truth is, if you think India is an IPO factory, the USA should be an IPO gigafactory because of the data. Even if we exclude 2021, where 1,000 companies went public in the USA, because of the SPAC boom, the USA is still far ahead of India when it comes to IPOs. Now, typically, an Indian SME IPO, which raises a couple of crore rupees as part of the listing, would not even qualify in the USA for consideration by a private equity firm to acquire it. And therefore, India's capital markets are slightly different. We have a very long tail of listed companies that are small to mid-size, and then a small head of companies that are large size. Therefore, India is not an IPO factory. Takeaway number 7, India's market cap to GDP ratio. Should you be worried as an investor? Before we give you the answer, I'd like to hear from you in the comment section. As a percentage figure, what is India's market cap to GDP ratio? Is it 50%? Is it 100%? Is it 150%? Or is it a different number? Before we give you the India market cap to GDP ratio, let's look at China and USA. So in China, the peak market cap to GDP was 119.3% in December 2007. The current market cap to GDP ratio is about 64.3%. The USA, on the other hand, is 175% as of right now when we're recording the video in April 2025. So how do you interpret these ranges? Market cap to GDP ratio is very simply the total market capitalization of the domestic stock market divided by the nominal GDP of the country. If it is 50 to 75%, it's considered modestly undervalued, 75 to 90% fairly valued, 90% to 115% modestly overvalued, above 115% extremely overvalued, which should be a sign of caution for investors. And therefore, this tells us that China is modestly undervalued, the USA is dangerously overvalued. So what about India? In December 2024, at the time of publication of this report, India's market cap to GDP was 140.2%. As of today, while we're recording this video in April 2025, it's 115.78%, just at that barrier of being dangerously overvalued. And I personally would not panic about this. In September 2024, India's market cap to GDP was at its peak, 154%, and this is the highest it has ever been since December 2007. The absolute low of market cap to GDP was in March 2020 when we hit 56.5%. The median, which is approximately the average of India's market cap to GDP, is about 83%. So the confidence or the relief for me as a retail investor in India's public markets is the market cap to GDP as of right now in April 2025 is closer to the median than it is to the peak. Do you need to worry about this? Not really. Takeaway number 8 is how has the mutual fund inflows changed in the last few years? When you look at the data in front of your screen, you would observe that the assets under management in mutual funds in the last 5 years has almost doubled. But very interestingly, the amount in debt mutual funds has not changed at all, whereas the amount of money in equity mutual funds has more than tripled. This is a clear indicator that in the last 5 years, Indian investors have been in a risk-on or a risk-seeking mode, which is why debt is flat and equity mutual funds have 3x'd. Now, this report was published in December 2024. As of today in April 2025, what does the data tell us about the mutual fund inflow? It's typically well known in the asset management industry when the market is close to the bottom is exactly when the retail will stop their SIPs, withdraw their mutual funds and take the loss. When you look at this clipping from the Economic Times, you will see that in January, February and March, the net new SIP additions turned negative, and they're almost 2 times the number of pauses or discontinues as compared to what was happening in 2024. Now, net new SIPs turning negative means that people are withdrawing, discontinuing, or redeeming their SIP. And when you look at the mutual fund inflows for January, February and March, you will see the same data. In January, the inflows were 57,000 crores, February inflows were 47,000 crores, and March, when the market had hit close to the bottom and certain investors were buying, mutual fund inflows dropped to 13,000 crores. So there is the old joke that retail investors buy at the top, sell at the bottom, There is some precedence to that when we look at the data that is available to us. Takeaway number 9, are FDs dead? When we look at the historic data, you can see how the mutual fund inflows have really skyrocketed. So when we look at the ratio of mutual funds AUM to fixed deposits AUM, you will see that in the last 14 to 15 years, this has grown from about 15% to almost 30%. To be very honest, the fixed deposit interest rate has actually been quite volatile over the last 5 years. Bank FDs hit the bottom in 2020 with about a 4% interest rate. They recovered in 2022-2023, going all the way up to 6.5%. And in the last couple of weeks, in March and April 2025, we have had 2 sets of repo rate cuts from the RBI from 6.5% to 6.25%, 6.25% to 6%. And the RBI repo rate is what influences the interest rate that is paid on fixed deposits. So while the market mania was going on, a lot of people realized that the FD interest rate was extremely low and therefore allocated even more money in the mania to the market. There's an interesting startup called Stable Money, which is part of the portfolio of Z47, the venture capital firm where I work at. And Stable Money was launched in 2022-2023 when the repo rate hit its current maximum. The stable money thesis was that the only way you can cultivate first-time investors is to help them preserve their capital. And the only way to grow your wealth while preserving your capital is by limiting your downside. And this is only achievable via fixed income or debt financial products like fixed deposits and covered bonds. And they were pitching the fact that the FD interest rates are at an all-time high, and this is the best time for you to book long-term fixed deposits. And cut to today, 2 years later, the land grab thesis of theirs that this is the best time to inculcate first-time investors into the habit of fixed deposits and get them locked into fixed deposits with the highest interest rate was bang on. So are fixed deposits dead? The answer is no. And in fact, fixed deposits are most likely going to be here to stay because a lot of first-time investors in India's public markets who've been burned with the current drawdown may end up exiting their public markets positions entirely and stick to the age-old advice of fixed deposits. The 10th and final takeaway from the Zerodha Capital Markets report is what is going on in India's private markets. The data on private market funds reveals a few interesting themes. The first and obvious one is that there is literally no further interest in infrastructure funds. In the last 5 years, the AUM held by infrastructure funds remains unchanged. But the AUM held by venture capital funds has grown almost 3x from 11,700 crore to 35,000 crore. And the very fact that the venture capital funds, which have the highest illiquidity risk, highest probability of capital erosion, have seen such a fast rate of AUM accumulation points to just one thing, and that is because some investors, especially the ultra high net worth and family office clientele, have made real money in the public markets, they are increasingly seeking diversification, which is allocation of assets away from the public markets to the private markets, where they are willing to take on serious risk to generate alpha or incremental returns. To recap, there were 10 takeaways from this Zerodha Capital Markets Yearbook 2024 report. That's all for this week's breakdown. We'd love to hear from you in the comments section. What are some other topics we should cover? So please do like, comment, subscribe, share this video with a friend, and hit the bell icon. That's all for now. Until next time. Thank you.